Good evening, and you're welcome to another episode of Let's Talk About. It's your weekly or midweek program that comes to you from the Trinity United Church. And there's an opportunity for us to connect, to talk about all the things that matter to us as Christians living in these times. And for today, just as a continuation of a conversation we had begun last 2 weeks. Last 2 weeks we talked about the debt recovery program, what has been dubbed the domestic debt exchange program. And last 2 weeks we were asking, what is in a haircut? Well, we are continuing that conversation today, and today we are asking, what are the implications of this program on you as an individual if you have any investment, be it directly with the state or through a fund manager in a pooled kind of arrangement. And last 2 weeks we got to learn that, well, there were certain terms to this entire arrangement. Between then and now, a lot has changed. And so we are here to bring you an update on all that has happened between then and now, and also to drill down specifically into what the implications are for you as an individual, what are the options available to you, what is supposed to be your response. And today, to help us with our conversation is someone that is not alien to us, especially if you're a member of the church. She's one who is a member of the Young Adult Fellowship. She is an associate professor of finance with the University of Ghana Business School. And, well, yes, she is a family woman with a husband and children. Ladies and gentlemen, help me welcome my guest, Professor Vera Fiado. Prof, welcome.
Thank you very much.
Great. So now that we know who our resource person is, before we go into the very conversation, let me remind all of you that this program is live on our various social media platforms, and I'm talking about Trinity United Church Legon social media platforms, both on YouTube as well as Facebook. So you can connect there, and you can send us your comments, your questions, your contributions in whichever form on our respective streaming platforms. So on Facebook, you can drop your comments there. On YouTube, you can drop your comments there as well. Alternatively, you can drop us a WhatsApp message on the number 050-1579-996. That's 050-1579-996. My name is Benjamin Ofeado, and I'm going to be your host at Post as we do this conversation this evening. So let's go straight into the convo. So, Prof, I mean, for the benefit of those that today is their first time tuning into this conversation, they probably did not have the benefit of last 2 weeks. Where have we come from and where are we now with this debt restructuring program, debt exchange program, economic recovery program, whichever we would want to christen it?
Okay. So I think somewhere around the 5th of December, we got the news that government wanted to do more of a debt exchange. And that debt exchange is something we normally would fall under the debt restructuring. So of course, debt restructuring typically occurs when, as the terminology, you are restructuring your debt. So what it meant was government had borrowed and for some reason found itself in a position maybe not being able to fully service that facility, and so wanted to engage its creditors to restructure and see how best it could still meet those payments, but in a manner. And of course, this is actually on the back of wanting to go onto an IMF program because we are actually constrained, and that meant that when they did the assessment, it found our debt levels to be unsustainable, which makes sense, because if they're going to inject some money into the economy, they want to be sure that debt sustainability is on track so that the money that comes into the economy would be able to get into the right areas and then propel the economy. But if we are bleeding so much from that side, then that money that comes in typically ends up in those, leakages, etc. So can you restructure the economy in such a manner that allows you to service your debt and also then makes the best use of these funds that we are seeking to get from the IMF.
Okay.
Of course, when they did roll that out, the first round was clearly complete lack of engagement of stakeholders. And I guess that is what triggered the whole hula baloo, because for a number of the affected parties, pension funds, etc., these had to do with people's lives, their livelihoods. For some, they may have even been made redundant, and the monies they may have received is what they just bought, what we'll call government risk-free. For that has come up several
I'm sure
times.
we'll spend some time to talk about that.
So they've invested in this government facility that they are hoping will see to it that for the period of time for which the facility runs up until it achieves maturity, these are the cash flows that and then suddenly this one comes in and distorts everything. And I believe that, and in fact, the initial repayment plan was quite scary.
Okay.
Actually going to get people to lose significant amounts of money. In the process, I think what has actually gone, I think it's still wrong, and it will take a while to get back fully, is the public confidence in the financial system. And once that begins to move on the wrong side, it means that loanable funds are going to be quite difficult to come by. Okay. And every economy runs on that. So that's...
Yeah, and in your explanation, you've used a lot of terms that, for the benefit of our viewers and listeners, we would want to break some of them down. So when you say debt sustainability,
yes,
what does that mean? For a country, if we say our debts are not sustainable, what does that even mean?
Okay, so sometimes when we look at it from the macro level, sometimes it feels like it's so far off. But when we talk of debt,
so when you say macro, you're saying at
the whole
national
level. But let's bring it down. Take yourself, Ben here, or myself. We're actually an economy.
Yes.
So when your debt is unsustainable, what it means is that you are not capable of servicing it. And for that matter, even for those who take bank loans, you realize that they normally want to take a look at your income statement, and that's your salary, your pay slip, and get a sense of how much you are taking in terms of income.
Yeah.
There are rules about how much of your money or income should be going to service debts, if you have any.
Yeah.
Now, when you begin to breach certain thresholds, you're only going to go into a spiral. What it means is that, because you see, debt is a fixed, it comes with fixed costs in terms of financing. So if you've gone to borrow, and for some reason your salary is, let's say, 1,000 cedis, and you've gone to borrow, and the servicing the bill requires that you pay up 500
every month.
Every month. What it means is when that 500 leaves, you are stuck with 500.
Yes.
It means you have no room whatsoever to accommodate contingencies, emergencies, what have you.
Yeah.
It makes you very fragile. And we all know that nobody really controls how life plays out. And the same thing for an economy. You can't tell everything. So when you have actually taken on so much debt, the flexibility and the fiscal space, so let me explain, so that the opportunity to be able to maybe increase this, do that, the room to even maneuver as an economy, you shrink it.
So let's see if we can get it in very layman's terms.
Yes.
You talked about servicing the debt, you talked about financing the debt.
Yeah.
So basically you are saying, if I have taken a loan of an amount, say 1,000 cedis, or let me say 5,000 cedis,
Yes.
and I'm supposed to pay it over a 10-month period.
Yeah.
But my earnings on a monthly basis is 1,000 cedis. What that means is when 500 of my 1,000 is taken out every month
Yep.
to make part payment of my debt, what you are calling servicing,
Yes.
what is left, which is the remaining 500, becomes too small for me to accommodate the expenses I will typically incur every month and those that I don't anticipate but may come up. What you are calling the contingencies.
Yes.
So I have very limited options in terms of what I earn to take care of some of these expenses as they fall due.
Exactly.
So that's basically the story.
Yes,
so for us as a nation, we are saying that we have taken a lot of loans.
A lot.
But looking at our earnings as a nation,
tax revenue et al.
They are not enough
at all
to cover for even paying
the interest
portions of the
debt, let alone the amount itself.
Okay, so what some people say, we've eaten the meat to the bone. Okay, so that understanding is, so that is what has brought us to a point where we now need to get support.
Yes.
And so why do people who have investments with the government have to be involved in any of this?
Okay. So when we talk of government debt,
yes,
public debt, there are two sides. There's a domestic one where individuals or entities, domestic residents, etc., have loaned money to the government.
Yes.
Typically in the form of bonds and notes. Normally we do more of the bonds and notes, yes. Yeah. And then there's the foreign aspect where we know we went to the international financial markets and we've heard of the bonds and the euro bonds and the whatnot. So we've got the foreign side. So here, when we talk of government's public debt, we've got two faces. The foreign face and then the domestic face.
Okay.
And that is what is contributing. Yes, with the foreign one, yes, they issued some whatnot. They are still making talks to find a way of, finalizing. But what is domestic is what we are facing to the core. And so now, once it comes to domestic, the question is who actually are part of the people who have loaned money to the government. And that is what has brought about. So now they're looking at the indigenes and the local sort of who have lent money to the government. Government says, something, servicing you will be difficult. So I want to exchange the original agreement, which was supposed to, so like somebody owes you and it's supposed to be up for payment in 2023. And then they look at their books and they say it's not possible to pay you. And so now they want to come in. The original contract literally is supposed to be ending, sort of.
Yeah.
Now they want to swap that for another new deal. So they are exchanging.
Okay.
Ordinarily, you expect that if you're exchanging for something, we always have this funny statement, exchange is no robbery. So typically, I should not feel like I am being robbed.
Yeah.
But I think in the initial stages, we didn't handle it well as a nation. So the affected parties clearly were being robbed to lose significant value.
Or at least they felt so.
They felt, that's what I'm saying. They felt like they were being robbed because then doing a colleague of mine, Eliklu Agbola, did one or two research elements in that area. And for the initial deal, some were going to lose as much as, like everything was just going to fizzle out because, when you look at loans or whatnot, or bonds in this case, we look at the present values.
Yes. And
present value literally means that, and we do it in this, in our local parlance, we have statements like somebody owes you 10,000, they decide to pay it in bits of 200 cedis, 200 cedis. What do we say?
We say, what says you can?
Thank you. And so with the initial structure, that is what it looked like because, one, they were delaying the payment. And we all know how the CD and the dollar and whatnot, how the currency has been dancing. So if you owe me 10,000 cedis today, but you're not going to pay me my 10,000 cedis today, and you're going to defer and pay me like 5 years down the lane, and you are not adjusting for whatever value elements that will be lost in that transition period, by the time you're paying me my 10,000, it could be as useless as no money. And so those were the issues that started coming up.
Okay.
Suffice to say that by the initial offer of 15 years plus, they were literally asking people to live by force.
Well, potentially, certain people could die.
Could easily go, including the pensioners, etc. Yeah. And that was...
So that was the initial arrangement.
Yes.
So as I did indicate in the introduction, what was happening 2 weeks ago is not necessarily what is happening now. And she was talking about price and value. Some people say yesterday's price is not today's price.
Exactly.
Right? So the value of 10,000 cedis today will not be the same value in 5 years' time, because with the passage of time, prices of goods and services typically increase. And if you look at Ghana's situation, to the extent that we are not recording a negative inflation, what that means is prices are increasing. So the 10,000 cedis, what it can buy today, is not the same value of goods that it can buy in 5 years' time. And that's why people were expressing concerns over the duration of close to about 15 years for the various instruments. But we are not there anymore. Where are we now? What is the new proposal from the government after the various stakeholder engagements?
Okay. So, now about doing that, I think from what we are getting now, those below 59, so now we are moving away from this 15-year horizon to a 5-year deal, which I think may get people to warm up a bit more, so most likely. And then for those who are not exactly on the pension line, they are being offered a 10% deal. And then those who are, of course, pension, meaning that there's no other way you are working except for whatever you've already accumulated, they are being offered 15% for the 5-year period.
So
to
when
the
you
retirement.
15% coupon. So for those, I mean, for the benefit of our viewers and listeners, when you say a coupon on an instrument, what is it?
So the coupon usually is written as a coupon rate, and so with the coupon rate, it's calculated as a percentage of the value of the, what we normally call the face value, the redemption value. So if you've taken, let's say, you purchased a 1 million CD bond, for example, it means that for a 15% coupon, if that's the coupon on it, it means you're getting 15% off the 1 million every year. But normally it's split into semi-annual payments. So it means that every 6 months you get half of 15%, which intrinsically is what, 7.5%.
Exactly.
So if you were doing the 15, that would have meant around 150,000 CDs for the whole year, split into 2, that gives you about 75,000 every 6 months.
Every 6 months, okay. And so those are recurring flows, inflows to you, the bond holder,
exactly,
or the instrument holder,
yes,
which comes through as some form of liquidity, instead of waiting till the end of, or to maturity, where they pay you the face value together with the interest.
Yes.
So they pay those portions by way of interest to you every 6 months.
Every 6 months. And then ordinarily, barring any new, clauses in there, upon expiration, let's say the last batch, the last set of 6 months, so in the 5th year, since it's now a 5-year facility, you will get your 1 million back. So that is what they are proposing now. So those are the
in
issues.
Addition to whatever
the 750 that you would have.
Okay. So now I think further clarity and emphasis. So if I am 57 years, you are saying that I am within the class of non-pensioners.
Yes.
And so I am going to be receiving 10% of, let's say, my 1 million every year, but in 2 tranches on a 6-month basis.
Yes.
So I'll be receiving, let's say, 500, or I mean, would that be 50,000?
Yes. So
I suppose that would be 50,000.
So 100,000. So 50.
So 50,000 every 6 months.
Yes.
That is what I'll be receiving.
Yeah, exactly.
But for the one who is, say, 59 and turns 60 this year, or the person who's already 60 or more, that person is going to be receiving 15% of that.
Yes.
And so there's been a separation of pensioners and non-pensioners.
And non-pensioners.
What was the rationale from the kind of communication that came from the Ministry of Finance behind this kind of segregation?
I'm looking at it. I haven't looked at their full report on that, but I'm looking at it from the point of view of, I'm sure, the whole thing is about becoming sustainable in terms of the debt repayment.
Yeah.
So I have a feeling that maybe this time around they've gone back to look at the profile of, and then they decided, okay, we've got a certain number who are actually on pension.
Yeah.
For those, we should not disadvantage too much. But maybe if they include everybody who is going to go on pension in the next 5 years, it might actually tip them into the same unsustainable mode. So I'm looking at it from the point of view of, and clearly every decision they have taken over the past few weeks, etc., has all been to reduce as drastically and as much as possible the liabilities that they have accruing. So I'm thinking this may have just been informed by a need to, and then find something they can use as a justifiable clause. If you haven't hit 60, which is the pension age legally, then they can say you are below pension. So once they flag below pension, it catches you, and then I'm sure they're looking at it in terms of what can we sustain. So I think that's maybe there.
And you know, in addition to that, for those who now become pensioners this year, they are also captured in the pensioners category. So if you are 59 and you turn, say, 60 this year, you've not turned 60 yet, you are still categorized as part of the pensioners grouping. And so if you have an instrument and you are 59 years, well, the good news is you are going to get a 15% coupon arrangement, as opposed to those who are still within the working bracket, who are going to be receiving 10%. And we need to say that this is a marked improvement upon what was earlier on offer, where indeed for even the first year of this arrangement, there was not going to be any coupon payment at all. And for the second year, there was going to be only a 5% coupon arrangement. The next year, 10%. And that 10% is sustained for the rest of the exchange program tenure. So those are some of the main changes that would have come up. So all of these that we are talking about are for people who are holding direct instruments with the government.
Yes.
And so they are viewed within the Central Securities Depository. That they hold a government instrument. We are learning that those who are holding treasury bills are not part of this arrangement.
That's what.
For those who are part of collective investment schemes, like the mutual funds and all of those people, but their monies in those mutual fund arrangements have been invested in some of these instruments. What does this mean for them?
At this point, that's the whole idea that has been, you know, a bit murky here and there. But given the peculiar situation, it's all about engaging the stakeholders. I know that for some of these funds, the story, and we're hoping it works, is the fact that they're going to have some kind of a stability fund, where if there are people who require payments and the institution, so here they're making some kind of arrangements for the institutions to be able to fall back on, even as we navigate this terrain. And so I think it is because for the individuals, there's nowhere else to look, or to nothing else to cushion them should they fall from this particular debt exchange. So I think they've done that. Maybe I'm not sure what else they have up their sleeve to offer to the collective investment schemes that somehow have roped it in. But I think they may be relying on previous returns that may be able to sort of cushion some of these, and should these institutions run into liquidity challenges as they are navigating, maybe then they can fall on this reserve fund that they want to come up with. Yes.
You know, people ask the question of, for me as a direct bondholder with the government, we are being told that this arrangement is a voluntary one, right? You need to elect to say, I want to be a part of it or not. But then the suggestion is, as much as possible,
be a part.
Let's be part of it. So there is the Boame Namensu Memboao, as articulated by the finance minister. For me, that I have money in a collective investment scheme, do I also have an option of making an election through my fund manager that I don't want to be part of this arrangement? Do I have that opportunity?
I am thinking that from where I sit now, I'm not too sure of that, because by going through the collective investment scheme, you sort of ceded that decision making, a lot of it. So unless there's a whole, you know, engagement also, second level. So here it's like you have co-opted to make your fund manager your decision-making point. So at this point, I believe most of them will be relying on the fund managers to make what will be an informed decision that ultimately benefits or it's in the best interest of the beneficiaries to that investment scheme.
So if you have, let's say, you're part of a mutual fund arrangement and you have committed to any of these institutions, whether it is EDC or Data Bank or Stanbic Investment Management Services, whichever one of these, what by virtue of you actually signing on to such an arrangement you have done, and you would sign a contract around it, is you are ceding, as you were saying, you are giving the options or the ability to exercise options to these institutions, because it's not an arrangement where you are expecting a fixed return or a fixed income. It is based on the performance of the portfolio, which they would have pooled and then spread out, that you'll be getting a certain return or income on it. So it is not as simple as the case of someone who has directly bought a government bond. So now let's switch into what we are to do if you are an investor, or in fact all of us, you have any excess liquidity, as the finance people will call it. You have some money that you want to put into some investment, and you had spoken about the trust in the financial system.
Yeah.
How does one now seek to make any return from whatever money savings that they have? Because traditionally we have been advised that you need to learn to save, but you shouldn't only save, you should invest. Because if you are just saving, you are losing value. When we come back from the break, which we'll be going to in about 3 minutes, we'll be going very deep into it. But just by way of introduction, what should be the options that an investor should be considering?
Okay. So if you look at it critically, what we really have here is the current situation, and I jokingly say that to some of my friends, I don't say that, we have somehow skewed every kind of investment, typically government. And I make a statement, I say that typically government does not invest mostly based on viability, but mostly on welfare. That's to grow the economy. So what we currently are facing, if you ask me, it speaks to a structural issue we have within our economy.
Okay.
In the sense that we are not investing in real production.
Okay.
But we are expecting financial returns. Now this is it. Real production is when you got productivity going on, so landed property, buildings, machinery, equipment, manufacturing, acquisition of knowledge, so even educational facilities, etc.
Service provision.
Yeah, that is the productive sector. Then the provision of money to fund that production is where we then reap the financial returns on financial instruments.
Okay.
Fortunately or unfortunately, in our economy, we seem to have ignored the production, but we are looking for the cream. And the cream can only be on top of the cake.
So you can't put something on nothing.
Exactly.
Okay.
So we are not producing, but we are looking for returns. And then, in that regard as well, whilst we are even not producing, sometimes we are not even, for some reason, we don't seem to be able to fund the real sector that properly. And so everybody is chasing government funding. The flip side also is that if we're all producing, therefore we're all paying taxes accordingly based on our production, then government will be making enough tax revenue and therefore not be running the kind of deficits that results in it trying to borrow, because most of this borrowing is to fill up the deficit of government has to spend, let's say, 50 billion, but its tax revenue is only 20 billion. It's short by 30 billion. And in a typical investment environment, the players in there, the ones who usually have surplus accounts, are the individuals typically. So either they're going through collective or they're going one by one. Those are so then government comes in and government needs 30 billion. And so then because they need money, they make an offer and everybody jumps on the government bandwagon. Sometimes what it also does is it crowds out the private sector, which even shrinks it further, and therefore they can also offer very lucrative returns. And we've all put their money in government, but government is not investing in the kind of areas that will yield the returns that...
Government doesn't produce anything. That's in essence what you are saying.
So to a large extent, that's really what is happening. So we are chasing really non-existent, should I say, returns.
Okay.
And that, in a sense, because government was making enough value from the monies that it actually also borrowed from us, then it should have been able to easily service its facilities, and for which reason we won't be where we are today.
Okay. So we are going for a quick break. For those of you who are just joining, this is Let's Talk About, and today we are talking about the debt recovery program, what the implications are for individuals. And our resource person today is Professor Vera Fiado, who is an associate professor of finance at the University of Ghana Business School. She's a member of this church, actually a member of the Young Adult Fellowship. We go for a quick break. When we are back, we continue the conversation. We'll be zoning in a lot more on what is supposed to be our attitude now. She sets the foundation for us to appreciate what is going on, what the terms are. Now, what are supposed to be our actions, the various options available to us. Drop us your comments in the comment section, Facebook, YouTube, as well as on our WhatsApp number, as we did announce early on. When we're back, we'll read them and we'll further engage. Stay with us. With the growing challenges of life in light of both global and domestic development, the Christian is faced with the difficult task of balancing survival within a secular system and at the same time living a Christian life that pleases their Maker. It is for this reason that we need to have frank conversations on the many issues of life through the Christian lens. So, we bring to you Let's Talk About. On Let's Talk About, we talk about health, career, dating, marriage, family, divorce, politics, finance, and all the issues of life that the Christian is confronted with on a daily basis. Join us this and every Wednesday on the YouTube and Facebook pages of Trinity United Church Legon, and let's talk about life as Christians. With the growing challenges of life in light of both global and domestic development, the Christian is faced with the difficult task of balancing survival within a secular system and at the same time living a Christian life that pleases their Maker. It is for this reason that we need to have frank conversations on the many issues of life through the Christian lens. So, we bring to you Let's Talk About. On Let's Talk About, we talk about health, career, dating, marriage, family, divorce, politics, finance, and all the issues of life that the Christian is confronted with on a daily basis. Join us this and every Wednesday on the YouTube and Facebook pages of Trinity United Church Legon, and let's talk about life as Christians. You're welcome back. This is Let's Talk About, and it's coming to you from the Trinity United Church Legon, and we are live on Facebook as well as on YouTube. You can send us your comments, and we are happy to have them read and for your questions also responded to. We are talking about the debt recovery program, the debt exchange program, the economic recovery program, whichever way you would want to look at it. And we are talking to Professor Vera Fiado, who is an associate professor of finance with the University of Ghana Business School. She's a member of the Trinity United Church Legon and also a member of the Young Adult Fellowship. So, Prof, before we went on the break, we were looking at what the issues of trust within the financial, or trust in the financial sector, is going to lead into by way of people's actions. And you went a bit into even how the financial system works. It is supposed to be an icing on the cake of the productive sector, providing finance for it. But we are not as deliberate about the productive sector with our investments. And so it's like putting something on nothing and expecting it to hold. Mm-hmm. What opportunity, even before we come to the individual, what opportunity does this arrangement or this situation where we find ourselves, where people are realizing that the government actually doesn't produce anything. So if you are giving money to the government, what the government is basically doing is taking your money now to spend it on one thing or the other. And when you are due to be paid, they'll go and take somebody else's money to come and pay you. What does this present to us as an economy, how we view the economy and how we do things in it?
Yeah, so I think maybe there's a wake-up call for businesses or for individuals in general to start looking at constructing portfolio. You know, when you actually look at typical investments,
yeah.
Yes, you may be risk averse, meaning that you're not really somebody who likes to take risk unless there's commensurate return to match it up. So in constructing your portfolio, whilst we look at liquid investment, which of course the government securities are supposed to provide in.
Depending on the tenor.
Thank you.
Yeah.
Typically, of course, they are liquid because they work on the premise of the risk-free and typically written on the treasury of the state. That's why we call them treasury facilities.
Yeah.
The assumption is that even if government doesn't have money, they can tax you yourself to pay you back. That's supposed to be the notion behind the default risk-free nature. So when we say risk-free, it means it's typically default risk-free, that if they don't have the money, they would even tax you, they'll print money, they'll give you something.
Yeah.
They will not go an outright default and not pay up. So that's where we get it. But in constructing a portfolio, it behoves on us now to begin to consider that beyond just the government's risk-free investments, are we really investing in proper? Are we intentional about funding the productive sector on which the financial sector actually rides?
Yeah.
And if we are not intentional about that, I think this cycle is only going to, we are resetting the wheel in another set of years. And if you go back, actually, it's not strange. We've gone HIPC, where the forgiveness came from other places. And if you look at the cycle, it looks like we just keep on.
Would have done the economic recovery program.
Thank you, FinSIP.
Structural adjustment
Thank
program.
you. So if you look at it, honestly, I think that was in the 80s, the early 80s. Then we ran, and by 2000 we went HIPC.
Yeah.
Now we are another 20 years thereabout, we are doing this one. So then the question is, it begs the question, we may be doing something not so right, and we need to. So we just reset the wheel, and then we run the same cycle. We are chasing financial returns, not real returns in terms of the investment, the sector, real sector, and that would bring us back to the same point, if you ask me. In another 20 years, 25 years, depending on how we're able to stretch it a bit, maybe another 25 years, we might be repeating the same
That's if we don't do things differently.
Exactly.
So the doing things differently is where the question is now. What are supposed to be the specific measures? Still staying at the national level before we come to the individual specifically, that we are supposed to be doing. Where are we supposed to be focusing our excess funds?
Yeah. So at the macro level, for government in particular, one of the key things, which we say, but sometimes I think we don't implement fully, is to create the enabling environment for private sector to take over. There are a lot of things that government should not do. All government really needs to do is to create the right environment, the right incentive, and then the private sector steps up to take. So sometimes you read, and studies have been done that'll tell you that, okay, sometimes for secondary education, up until secondary education, for example, yes, government can support. But once you go tertiary, sometimes even for some studies will tell you that after the first round of basic, up until, let's say, JHS, maybe government may want to start, taking its hands off. And by the time you are hitting tertiary, it's supposed to literally step out. But what we do is that sometimes we're spending a lot more money. So government now has to be more intentional about where it spends its money. Now let's take, for example, a flagship program like the Free SHS.
Yes.
Great idea. But then if you look at it critically, the implementation is part of where we are here. You're investing in something that has a very long tenure in terms of maturity to yield results. Yes. Yet you've got a tenured facility that is funding it. And so now the tenure is up to make good on the liability that was used to fund this asset, but the asset is not yet mature.
So we are not matching our assets with our liability.
That's one area that macroeconomically we are not doing great. Secondly, some of the things, like I said, we are not, so beyond, let's say, law and order, which you cannot give to somebody based on ability to pay.
Yeah.
There are a lot of other areas that government should either be having serious collaborations with the private sector. In some cases, just provide the incentive and then let the private sector take it up. But sometimes I think it comes up periodically. We seem to mix a lot of political babies and pet projects with national development agenda. So in the process, we mix a lot of things that sometimes we shouldn't, and that is what can actually lead any government, whether opposition currently or non-opposition, to face something like this.
So if you didn't hear anything at all, at least 3 things that could bring us back even if we get out of this. And that in itself presents 3 solutions of not getting there again. The first thing being the fact that governments, and this is a lesson for also businesses and even individuals, matching your assets with liabilities as they fall due. So you don't take a liability which becomes due for payment. Meanwhile, your assets are locked in instruments. The maturity time is beyond when the liability falls due. That becomes a problem. So our asset liability management is very important. Second thing, the fact that it is not everything that have to be shouldered wholly by the government. And so if you're a business as well, it's not everything that by yourself you should be doing. Partnerships are important. And so in the case of the government, they should be considering a lot more public-private partnerships so that the burden is released. And the last being, decisions should not be just based on political expedience, but national developmental agenda should be that which drives us. And so for you as an individual, don't take only emotional decisions when it comes to your investment. You need to be very rational around it. If for nothing at all, these 3 lessons we need to keep in mind. So coming back to the individual, I mean, there was a point where we had all of these motivational speaking, and we also had this buzz around entrepreneurship. Right now, we are saying that we should be mixing our portfolio and having a good chunk of it in the real sector, as well as those that we are keeping in near liquid instruments with some of these financial institutions. The decision of investing in existing projects or ventures, what should be the considerations that someone with excess liquidity should be making to decide whether or not to put their money into somebody else's business to be able to make a good return?
Yeah. So I think that definitely takes us into the realm of financial literacy. And where you are not so literate, it's important to have a financial advisor. Sometimes it may cost, you may think, but if you go like a 50,000, 100,000, and you end up paying even 1,000 or 2,000 to somebody, that even reduces your net amount. Let's say it reduces to about 48,000, and the person can advise you more, practically, sensibly as to where to put the money. And for that matter, you don't lose the entire remaining 48. It's better than you take the entire 50,000, put it somewhere where you don't even understand the principle of value creation, and then you ultimately lose all of that value, all of that money because of a bad decision. And I think this crisis we are going through maybe is a wake-up call. One, for most businesses now, raising money from the banks in terms of debt is almost like moot. I don't really see, currently most of the banks, even if they'd want to give you credit, will be doing like what, 40, 45%. No, I'm not sure. I'm yet to see any business that can consistently generate 45% return year in, year out.
In fact, someone was mentioning, someone did a quick analysis, like back of the envelope analysis, where they say, when you look at our treasury bill rate right now, you know, typically it is, because we consider it risk-free, it is relatively lower.
Low, yeah.
And the
Risky.
the fund managers, those, they probably give something a bit more.
Bit more.
Right now, they are actually offering something less than the treasury bill
Yes.
rate.
And so that speaks to the fact that is like a covering on, like we said, they're nothing.
Yes.
Yes. So now that we have reached that point, which is now shaking up the system, I see the rates in the long term hitting the teens and lower, because that's the most realistic. In fact, with this 10%, 12%, they were even high. You're going there and you see a bank from US offering, they're actually making noise about offering 4.5%.
But you see, that's denominated in Forex.
Yeah, but I'm saying they are offering 4.5% to their own people.
Yes, and it's a big deal over there.
It's a big deal. And we are still in our teens, and we think it's not a big deal. It's also, I think we've hyped the rates, etc. But more importantly, I think one thing we may want to start looking at critically, we need to begin to understand the principle of money creation or value creation, as we call it. A lot of us get into businesses or investments where we do not understand the process of value creation. And for that matter, we get into deals and make, should I say, investments that would ultimately fail us. Because every business has a process by which they generate money. And every business is intrinsically a buy and sell.
Okay.
So I offer consulting services.
Yeah.
You want to pick my brains, you come, you pick my brains, I train for you, or I write a document for you, and I charge for that.
Yes.
And so if I come to you and I say, I want to expand my facility from Accra, let's say, to Tamale, I want to set up an office in Tamale, and I come up with the budget for setting up the office in Tamale, anybody who is investing in my office in Tamale or helping me to put up the building in Tamale must understand how value is created in my business, which then justifies how much money they should be putting in, because they can tell how much value will be created at the end of the day. Half of the time, as individuals, we never bother to do any set of analytics. We just pump in money because we've heard a story. We don't do any analysis. We don't seek advice. We don't do anything. We jump in, both feet, hands, everything, sink the money, and then we wake up one day and realize that it was a sham, and then the money is gone. So maybe this is the time to wake up and, as individuals, acquire financial knowledge. Some of them could be investing an hour or two in yourself. You see a training program is affordable, you get it. If you have to invest something significant, then my recommendation typically would be to get a financial advisor.
Okay.
And for that matter as well, once you sign the contract and they put the money in the wrong place, you can decide to take them on. But if you don't and you sink the money and it scatters, then you've lost value.
And I think it's very important we take the point of understanding the value creation process underlying any arrangement that we are getting ourselves involved with. So we need to understand that for any investment, there's supposed to be an underlying asset. So what is the asset which underlies, or which is supposed to be creating the value that you are going to be getting that return from? If you do not understand that element, be slow to throw yourself into it, because then you are going in very blind and you just may crash. And someone put together a certain analogy. It says, it's like you are driving, you've broken your side mirrors, you've broken your rear mirror, you have blindfolded yourself, and you are stepping on the accelerator.
Let me add, on a one-way street.
On a
in the wrong direction.
Exactly. So you are very likely to crash. So it is important that you have visibility of what is the underlying asset, the main value creation process, and the instrument underlying that. You need to know that before you decide that, oh, these people are doing it, so I'm going to put money in there. So now let's move from those who are putting money in existing ventures. But now for those who actually want to put money into something they themselves are starting, entrepreneurship. What are some of the key pillars that, for the benefit of those who are considering that, they should be looking at? Because right now, I mean, there are all kinds of suggestions. We should be looking at go into agriculture, poultry production, crop production, I mean, livestock, crop. There are also suggestions around real estate.
Yeah.
If you have some money, you could potentially build a few, maybe a townhouse or townhouses to rent it. What should be the thought process that such a person would need to go through in deciding to venture into such enterprises?
Okay. So I think one of the critical issues we need to look at, if you want to go into any area whatsoever, one of the key things would be you need to be solving a problem. It's out of solving problems and solving the problems profitably that you make money. Now, if it is not a problem, it means that it's not a pain point, and so people will not take up the service. It needs to appeal to something inherent. Now, beyond that, you'd also need to be very intentional about getting your figures right. Do not be overly optimistic. So that also comes down to, and of course, we can stretch that a bit to even people who are already in business. This is the time to begin to look at your figures very critically. You don't cook up figures out of the blues and think that by cooking them up, they'll become a reality. Because that's what we do. And so you need to get a good sense of what are the real prospects.
Yeah.
And if they are the prospects, the next thing then is, even when you have sunk in the money, you need to manage the business. More often than not, I think a lot of us get into businesses like we are running hobbies. And we keep on taking money and pushing it in, but we've never bothered to step back and find out whether this business actually generates value. And when I talk of figures, for example, so not too long ago, I had the opportunity to engage the Chamber of Commerce on an issue. And so as we were talking, so this person comes up to me and says, so they've been running this business for 10 years, but they've taken this grant, this facility, but they're struggling to pay up, etc. So on one of the very first days, this person visits my office for just a one-on-one chat. So the person is talking like, okay, hold on. Let me just get a bit. What's your standard production run? Like your average consignment whenever you're producing. So we capped it. And then this person gave me, okay, normally I buy this quantum of that. By the time we finished and looking at the units that they're able to produce from that consignment, cost per unit was around 17.5 cedis. So I asked, so how much do you sell one? He said she sells it for 15 cedis. Oh. At that point, I was like, that's not possible.
Was it the case that they hadn't considered fixed costs absorbing that?
They had never considered anything, which is sometimes what we also do, like I'm saying, taking time to look at your figures.
Yeah.
Some of them have no idea at what minimum production level they should be running to be at least break even before moving into profitability.
Yeah.
And so they sink their money in, and they may actually be producing just below par. So it looks like all seems like it is well, but slowly you are chipping away at your capital base. So it might actually take 10 years, and then suddenly you realize that almost half of the money you've been running on is debt, and now it's due for payment, and you rob Peter to pay Paul. And so figures are key, and this is a time we begin to keep financial records for those who already even existing businesses and hoping to get people to pump in money, because now taking a debt facility is going to be quite, delicate, very difficult, if not almost impossible. But you need financing to sometimes continue on that journey. In some cases, you may even want to actually get a new owner coming on board to help you with their excess liquidity, which they have, like anyway, maybe I have some extra money.
Yeah.
If I get somebody who's got their figures on point and is trustworthy, I may then bring that money on board, which allows this person to retire a debt facility that could be chipping away, which may also be leading them to a debt restructuring sometime down the lane. And those are some of the issues as well. But even for you as an individual investor, if you want to get into that area, you begin to look at the figures and look at them. And if you are not too sure what they mean, get help. It's like signing a contract and not speaking to a lawyer.
A lawyer, exactly.
You may actually be signing your life away.
Okay.
And so,
interesting. And there are 3 things coming out of this. 1, know the solution you are seeking to create, or at least know the problem that your venture is supposed to be a solution to. You need to understand it clearly and know that people will pay for your solution to that problem. That's 1. Second thing she talks about, you need to know your numbers. You need to know your numbers. You need to go in informed. Don't be blind. You need to know your numbers. Else, even how you choose to price, you may be actually pricing below what your cost is. And that means you are not really in business. And the third thing she talks about is, in terms of financing, it will be good at certain points to consider partners. Other people will come on, because especially equity partners who will not be expecting immediate returns, so that you are not using debt for which you are supposed to be servicing to be the money that you are using for your business. So at least these 3 things, very, very important. How about your supply chain? What should an entrepreneur be considering when it comes to their supply chain?
Yeah, so of course, for all of these, then costs for the entrepreneur, of course, if you want to be on a path for success, you are trying to minimize the fixed components. So you try to minimize costs without compromising on quality. So supply chain, you look at who can give you good service or good product, but affordable prices, sometimes even good terms of payment. So sometimes by the time you do, and there are ways to do that anyway, if you seek help and you're able to calculate, okay, if I take from this person on credit, it accrues to this level of extra charge. So maybe, yes, if I buy for cash, I would have paid 10,000. But if I buy on credit, I would have paid 12,000. So someone says, okay, then let me go and borrow and use it to buy at 10,000. But if you're paying for 10,000 but borrowing at 25 or 30%, it means at the end of the day you'd have been paying 13,000 as opposed to 12,000, which was being offered. And so you need to understand all those things. And so supply chain, you need to look at the whole pathway and see where you can get synergies here and there, and then minimize the cost implications that come with that.
So there are suggestions that we need to secure those, especially in terms of your vendors, because the very things that go into your production, you may not necessarily have control over them. So you need to be certain that you are going to get that constant supply to be able to do your production and meet the need. How about having a ready market, establishing a market for a product? How does one go about establishing a market for their service or product?
Of course, that would go more into the realm of marketing and branding issues. But for a product to sell, there must be awareness. So when you don't create awareness, then of course then that's going to be a challenge. So beyond the main thing, when you get into a business, then you'd have to just get and create awareness for your product. It is when people are aware, because that's actually when you want to look at uptake of services or adoption. The first thing on the line is awareness of that product or service. It is then that people begin to link it and say, okay, maybe I have this need, this will fit it, and then it creates demand. And importantly, there's a study, I'm trying to remember the year, that talks about how entrepreneurial ventures fail. And one of the key ones also at the top is a lack of a market. They produce something that doesn't have a market, and that's the key. And at the heart of it actually is a financial issue so when your figures are not right, you end up restructuring like government is restructuring. That won't be a problem.
Great. So last 2 weeks when we had our conversation, Joseph Jemfi sent us a question, and I would want to put that to you again. He was asking that, he says, are we not on a debt peak to push for HIPIC than to sweep our unsustainable debt under the carpet for another loan from the IMF? Or are both the same?
You see, somewhere along the line, we got to be categorized as a lower upper middle income. So very interesting terminology.
Lower middle income.
Exactly. So we are actually on the middle income, but we are the lower echelon of that, not on the high. Now, for most economists will tell you that beyond just GDP and some 1 or 2 parameters, the real issues never changed. So the parameters that will typically qualify us for a developing, so like low income economy, everything is actually what it is. But by moving into that category, it's like when you become an adult, nobody feeds you milk.
Yeah.
Now we have become an adult.
You need to chew bones.
We need to chew the bones. Yet we have messed up our teeth. So at this point, so strictly speaking, for most economists who are telling us, a lot of the parameters didn't really fit except a few at the top. And then we used that and then we were catapulted, and it felt good to be catapulted and
Because we
considered
even rebased the economy.
Thank you. So to be given the category of a middle income economy.
Yeah.
But immediately we got into that, the freebies,
They all went away.
they all went away because now we're supposed to chew bones. Yet, we haven't developed the teeth. So in a sense, if you look at it in terms of the macro indicators, some of the things were still not at par.
Yeah.
For some of, but we have some, maybe part of our canine had come out, but the molars were still weak. So you look at the canine, like, oh, this one should be able to crack the bone, but after cracking it, you've got to chew it and mash it up, and we don't have those systems. So yes, where we have reached, we can only get facilities. And even then, those facilities, they all come with their clauses, not the very relaxed and flexy ones that we have earlier.
So we are having a question coming from Mr. Gershon, and it says the discussion is educative and insightful, a perfect pair of resource professionals. I have 2 questions, and the first one is, what is the difference between a bond and a treasury bill?
Okay.
And why are the bonds affected and not treasury bills? That's the first one. And the second one is asking, what is the impact of this debt restructuring arrangement by government on current pensioners on SSNIT fund payroll? So it's double-headed. So let's deal with the difference between bonds and treasury bills and why one is being impacted, the other not.
Okay. So in terms of when we talk of bills and bonds, it's all about timing.
Okay.
So when we talk of bills, these are facilities that have a maximum time span of 1 year, meaning that the contract comes to an end after 1 year. You want a new one, you need to run a new contract.
Yeah.
So you can have them, so you can have the 91 day, that's the 3 months typically. You can have the 182
day.
And then you've got your full
360.
Yeah, and then, so that's for the bill. What it means is that it's an engagement with government where the deal matures maximum. So you can have cycles within a year, but the final pakra would end in 1 year.
Maximum 1 year.
That's one. Then normally you would have what we call notes. So in fact, there's a middle line. So when so for the 1 year up to 1 year, we call them short term. So those are short term deals. It expires literally after 365. You want a new one, you don't necessarily roll over the original. There's a new deal that you sign on and you move on. So that then post the 1 year, sometimes to 3 years, we have what we call notes. So that those are like intermediate. Then when we begin to cross that one, we go into bonds. When we get into bonds, they are typically considered interest-only debt obligations that require that whoever is issuing them give you certain fixed payments over the time period, the tenure for which they agreed. So if it's a 5-year facility, you're going to be receiving interest only.
What we call the coupons.
The coupons. And then upon expiration of the contract, so when that contract comes in, it's a 5-year contract straight out.
Yeah.
You see, the bills come in, and it's a short contract, so you keep on sometimes rolling over, and the maximum you can ever get at any point is 1 full year. You want something longer that you don't have to be renewing every now and then you're beginning to look at notes if you want something intermediate, like up to 3 years.
Yeah.
Beyond that, then you move into bonds. So you can go even as far as 30 years. Plus, so yes.
And the intention is for you to hold it to maturity.
Yes, typically. But then there's the option where when it has a secondary market.
Exactly.
So normally you want to hold to maturity, but things can happen along the way where you need money. There's a market where people are ready. Somebody to maybe, because government or whoever may have issued a certain number.
Yeah.
So when for some reason you also need somebody to maybe have been watching, okay, this is a good deal then. So when you want to sell off, the news is literally broadcasted, and somebody too has told their broker that, I want to get
Buy.
this. So when they also get the information, so that
They can
brokerage
trade.
deal, there's a trading going on. So that's what gives rise to what we call a secondary market for trading. And so if you look at the debt exchange, one of the entities say that when everybody exchanges that for the new one,
Yeah.
what it means is that there will no longer be a market typically for. So unless you're holding it
Because
to
there are just
maturity,
few.
very few. So a market is any place we buy and sell.
Yeah.
So once there's an opportunity for people, enough people to buy and sell, then a market is created. So in this case, when you have bought the bond, but you're not ready to hold to maturity, if there are enough people around, you can actually trade it easily without losing so much value.
The second part of the question is, why are the bonds being affected and treasury bills not being affected?
Treasury bills are typically very short-term deals. All things being equal, when somebody owes you, the shorter the time to payment is less risky. But you see, with this one as well, because they have locked in, treasury bills for that gave governments opportunity that now that they are maybe talking about the bonds being offered at 10 and 15, chances are high that those are even longer term with higher risk of maybe not being settled. The flip side then is you're going to look at bills now coming down because they are now less risky, because the time period, if somebody you loan somebody money and they're paying you in 3 months, is definitely not as problematic as waiting for 5 years for them to pay you up. And so the bills also come in the sense that because of the recycling, the short-term nature, I'm sure they're trying to not touch that one also, because whether they like it or not, we all foreseen the fact that it's shaking the trust in the system. If you add the bills, I believe we're going to
go down.
And then treasury bills give them the option to refinance, hopefully maybe even at a cheaper cost. So yes, it could be 30 now, but maybe the next one they say they're giving 10%. It's either you buy or you don't buy. But with the bonds, they've locked it in. So unless they come out and do some kind of rearrangement, it means that even when they can't pay 20 or 30% because of the contract that is in existence and hasn't expired, they are supposed to make that. But for this one, maximum in a year, 6 months, they can clear, and then the new issue, they can drop their rates. But with the bonds, it doesn't lend itself to that kind of
flexibility.
easy.
And just to add on to that, the government right now clearly is also lacking options of getting financing. And the treasury bills offer them a short-term flexibility. So that's one area they don't want to put out an impression that they cannot refinance once it becomes due for payments due. So that side they will try to keep very clear, because it's an opportunity for short-term financing for a lot of the things that they have to do. Now, his second question, the impact of this arrangement on pensioners currently on SSNIT fund payroll.
All things being equal, I only foresee SSNIT trying to bite the bullet and pay whatever they are supposed to pay. Because I think even with the labor, I'm not a law person, but I know that they cannot necessarily vary their payments to your disadvantage. So I think I recently saw a request where SSNIT is actually asking government to revise the contribution from employers, etc., the SSNIT contribution, the tier 1.
From 5.5.
From their 13 point.
Okay, so 13.5 that they receive.
They receive. They wanted to go to 19.5. I saw something recently. So clearly, for them, because it's a deal that is running now, I don't really see it affecting the payments that the pensioners will be receiving. What I see happening is on the back end, SSNIT now has a responsibility to do all their magic investments to ensure that it yields the right returns to be able to keep up the payments that are due their beneficiaries.
And I think the government has also indicated that the Financial Stability Fund, which is supposed to be a buffer, is intended to support the financial sector. Pensions, insurance, fund, the securities, as well as the banks. So there's that assurance that pensioners will still be receiving their pension pay
Pay, yeah.
on a monthly basis, as is the arrangement. So they won't be affected. There's an arrangement to protect pensioners like that. And it's been a very interesting conversation, a very
Yes.
enthralling one. And I hope you have enjoyed it, and thank you for your feedback. But before we go, there are a few announcements that we would want to bring your way. And we get to spice up our marriages this weekend. That's for the various people who are married. And we're going to be having a couples dinner. And we're going to also spend time with seasoned marriage counselor Auntie Flora Saki. And it's going to be a special time this weekend. And it's all part of the love month of February and some of the activities. And for you to be part of this dinner as a couple, you just have to pay 200 cedis per couple. So 2 people, you are coming and you are paying 200 cedis. That's about 100 cedis per head for a dinner, a full-blown dinner. I mean, you can't get it anywhere else. The Momo number to make, in fact, I think it's a Vodafone cash number for you to make your payment is 020-842-2564. The number again is 020-842-2564. Once you send your money as well, I think it's important that you send the person also a message, or if you can even call to confirm that is what is happening. And it's going to be taking place this Saturday, 11th February, and the venue is the Trinity United Church Legon, Yaf Gardens. Yeah, so we have a very serene space here where that is going to be happening. It's going to be taking place at 5:30 p.m. And please, it is strictly for married couples. If you have intentions of getting married, you are not part. If you are considering what it's going to be like being in a marriage, you are not part. It is for those who are already in marriage. So yes, be duly advised. So we want to thank you so much, Professor Vera Fiado, for all the insights that you've provided us. And Professor Vera Fiado is an associate professor of finance with the University of Ghana Business School, and she's also a member of the church, a member of the Young Adult Fellowship. And we thank you so much once again.
Thank you too for having me.
And that's how we wrap up our show today. It's been Let's Talk About. We've been talking about the debt recovery program, the implications for individuals. We hope we've learned something and it's going to make your life as a Christian much better moving on. Join us same time next week, that's 7 p.m. as we bring you another episode of Let's Talk About. On behalf of the entire production team, I want to thank you for making time to join us. My name is Benjamin Ofeado. Do stay safe and have a good night.